Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions, generally related to three different topics: wealth building, commodities, and or financial topics. So let's just dive right in. Let's take a look and see what people are sharing, and I'll share my opinions as we go. If you want to follow me, at Finding_Finance, and if you want to join our community, finding-value.com, where we dive deeper into the individual sectors, individual companies. You can see my portfolio and how I'm playing this commodity bull market that we are in. So starting with myself, natural gas is the cheapest asset class in the world. Yes, U.S. natural gas specifically. So this is the futures pricing in relationship to Dow Jones Industrial Average. You can see where we're located with that orange circle. Very similar setup to where we were in about 2002. So a lot of things are starting to correlate with 2002, where we could see the dollar start to decline, maybe interest rates go steady, or maybe even get lowered in the future. But that is still up in the air that we are exactly at that point yet. But that's natural gas against Dow Jones at a very cheap level. Historically, natural gas versus gold, another historical, just off the chart how cheap this is, and probably one of the cheapest times in history. Natural gas versus copper, another one that is really cheap and one of the cheapest times in history when it's priced against copper. And then natural gas versus silver. I thought silver was the cheapest asset in the world, but looking at this, natural gas is actually cheaper than silver, and natural gas is cheap than platinum too. Platinum is cheaper than silver. So natural gas is the cheapest asset, I think, in terms of ratio and relative value compared to any other asset that I can find in the markets. Does that mean it's a good investment opportunity? I think yes, very much so. Natural gas is cheap, and we are adopting and using natural gas in ever greater quantities in the future. Last bull market versus today, and where we might be located: Dow Jones versus gold, or versus crude oil, I should say. Pull back. We have a pull higher here, and then the orange circle is very similar. Do we have one last move up? Maybe a slowdown in the market? I don't know about that. But it looks very similar to last bull market before. This was 2002, before we pulled all the way down into a much more expensive level where crude oil outperformed Dow Jones. It looks very similar to that. And are we going to pull back down like we did in 2002 all the way to the lower end of about 76? If that's the case, we would do from where we are today, we're at 478, and we would decline all the way to 76. 5-6 times the move is what we would get. I should say 5 to 6 times outperformance. This is oil versus silver, oil versus Dow Jones, oil versus gold, and oil versus uranium. Oil looks to outperform everything. What do you think? So this is crude oil versus silver. We've broken out of this downtrend falling wedge pattern to the upside and are sitting on top of the trend line, using it as support. Could crude oil outperform here? I would say yes, and we would get the confirmation if yields move up. If yields move down, I think silver. Are we going to get a slowdown, or is fiscal spending and the inflation from fiscal spending going to basically outmaneuver or overpower any slowdown in the market? That is a good question, and I don't know if anyone knows that answer. Here's crude oil versus Dow Jones. That looks like an excellent pattern. It's broken the fallen wedge to the upside, and we've consolidated inside of another falling wedge. Crude oil versus gold. Very similar to Dow Jones, a falling wedge broken to the upside and a consolidation and another falling wedge right at the tip. That looks good to go higher. Crude oil versus gold, which makes you think that crude oil could also outperform silver. And then crude oil versus uranium. I know we have a lot of uranium bulls, but this is a 3-hump consolidation that looks good to go higher. maybe even break this to the upside. Could crude oil outperform absolutely everything? I don't know. It sure looks like it could. Now, I'm not stating that it will. I'm stating that it could. And we have to see and watch it. I am positioned for that move. XOP energy, so diving deeper into some of this, because if crude oil is going to outperform, we should see energy-related investments start to outperform other sectors. Now, this one is energy versus energy service, because I wanted to see what could outperform what. So XOP is the exploration production companies. OIH is energy service companies. This is broken to the downside where I could see OIH outperform XOP. Another thing, if you want to flip it around, because some people like seeing it a different way, this is OIH versus XOP. We have a falling wedge that we've broken to the upside. And this looks good to move higher, where the energy service companies could outperform the exploration production companies. Now, I'm not stating that all energy service companies are going to outperform all of the exploration production companies. I think the exploration production companies that are high cost could go up substantially, specifically the small and mid cap range. But I also think that OIH and a lot of the energy service companies are also going to do incredibly well, coming from relative valuation levels as low as we're at. Here's XOP Energy versus GDX, the gold miners. What do you think? So XOP outperformed from 2009 to 2014. We had a massive outperformance of GDX, basically XOP crashing all the way down to the bottom. And then in 2020, 2021, we've had XOP outperform GDX. Now, is this going to break to the upside, or are we going to break to the downside first, where we get a recession slowdown in the market, an uninversion of the yield curve, where GDX would outperform? Or are we going to get inflation and enough fiscal spending and inflation where XOP will outperform GDX, and that spending in the system overpowers other things, more of a stagflation event? That is yet to be determined. We do not have a clear breakout yet, but that is something I am following. Scrolling down, it's Warren Buffett quote. He says, "I'm not interested in cars, and my goal is not to make people envious." Don't confuse the cost of living with the standard of living. And I think a lot of people confuse those two. They think that because you're spending more money, that you're increasing your standard of living. Now, I do think there's a couple of spots that you can increase a little bit of your cost of living to have a higher standard of living. One of those things is buying a really comfortable bed and a really comfortable pillow. Those things actually make a world of difference, and cheaping out on a bed and a pillow can impact your life dramatically. So that is one thing that I would not skimp on necessarily, but if you can find a really good bed at a really good cost, I wouldn't pass that up either. TLT, no breakout yet. Bond prices, I've been watching bond prices to see if I can engage a clear direction on where bond prices, aka yields, are going. So bond prices got rejected at this resistance line and are actually heading lower. Keeps in play that we could still see a downward move. It's still possible. And yields could still go way up. So it keeps that alive, that thought or that possibility, since we haven't really cleared any support resistance lines yet. Happy rig count day. Baker Hughes, oil's down 6 and gas is down 1. So we are dramatically declining in rig count. And here's U.S. nat gas rigs. They ease 1. That's what this -1 is, to 97. A new cycle low. So U.S. natural gas direct rig count, back in 2023, we were at 160. We are now down to only 97. So we have pulled back dramatically on our rig count. This is going to impact how many wells are drilled. It's going to impact potentially natural gas and the price of natural gas as production falls. And what's really weird here is you need about 6 to 8 months of lead time to get these rigs back up and running and natural gas flowing or oil flowing. So what happens if we get a really hot summer and a really cold winter? Or maybe we don't get as hot of a summer, but we get a really cold winter and we eat through inventory really fast. That means that we are positioned with rig count and drilling and all this stuff to the short, we'll call it to the squeeze end, to the tight end. And then we're going to have all this demand, if that does come. And I think we're going to have a gap between when we can produce and the rig count and all this other stuff. So we could see a huge spike in natural gas at some point if we get all the rig count moving left. We get a cold winter, which means demand moves right. And then the resultant would be much, much higher pricing. And then the rig count's going to have to catch back up, and we get higher lows, higher highs. And then eventually we could get higher highs and lower lows, where the volatility just goes ballistic in natural gas, which is what we don't want to see, because we keep shifting everything to electricity, and we're shifting all of our electricity generation to natural gas for the most part. Nike's down over 20% today. Charts showed you the probabilities of this possibility. Oh yeah, this looks crap. Big selling pressure move, a smaller bounce. Big selling pressure move here. Insiders or somebody's probably selling underneath this. Was that like a 200-day or 50-day moving average? And we've just sold right on down. The U.S. just witnessed the fastest ever deterioration in housing affordability. That'll happen when national home prices overheat, followed by a historic mortgage rate shock from 3 to 7%. So the U.S. just witnessed that fastest deterioration. You can see that in home sales. Now, here's the thing. This is generally what drives the market. And I think fiscal spending is really driving the market now. We got market forecasters will fill your ear, but will never fill your wallet. And that is his opinion there, and I agree with that. The market forecasters are people trying to predict short-term price movements. Doesn't make anybody money. What makes people money is taking a long-term approach, buying undervalued sectors and waiting for those sectors to become more overvalued, I should say, or more fairly valued at least. More information leads to more confidence, but not more accuracy. So more information does not lead to more accuracy. So basically, you can get more information, it increases your confidence, but it doesn't actually increase the accuracy of what you think could occur in the future. So accuracy, and that's where I look at all these sectors and people ask me about price targets. It's like price targets, in my opinion, are not good things to use. You can use them loosely, but your accuracy, because you do it, your accuracy doesn't really, it's not there. Your confidence could increase, yes, but that's a feeling, not an actual number. So what I do is I look at fractal sizing. I say, okay, we could get a big move to the upside, but you can't really put exact numbers on it because you're not going to be accurate. You're not going to be precise or accurate. What you're going to be is you're going to just look at the general trends. You say, yep, the trend's going to go up. We're at a cheap location. We've got a bunch of upside potential, and these stocks have sold off, and there's a big value discrepancy between the price of the stock and the value of the company. And then you exploit all of what I just said. But you don't know the ultimate move up. You don't know that. Your accuracy is still not going to be any more accurate. All you can do is say it's roughly going to be higher. And then you can guess kind of the magnitude of the move. Probably nothing, and this is Jefferies, container freight rates are just rocketing higher in 2024. Big moves there. Rock bottom entries, we've got gold divided by silver ratio, a bearish rising wedge rejecting at the 50-day. Expect a silver squeeze to accelerate, and I do agree with that, but we could see a big move lower with silver outperforming gold. Successful stocks don't tell you when to sell. When you feel like bragging, it's probably time to sell. John Neff. Warren Buffett on investing, and I do take a lot of information from him and implement it into my strategies. You have to make very, very few decisions in investing in your life. You might say that a person who bought Berkshire Hathaway 50 years ago only had to make one decision. There's a temptation for people to act far too frequently in stocks simply because they're so liquid. They know they can't buy and sell farms every day or buy and sell apartments every day. They can buy and sell stocks every day. In a very liquid market with very low transaction costs, that should be a huge advantage. But people turn it into a disadvantage because they think the opportunity to trade is something that they have to take advantage of every day. Actually, active trading just costs them a lot of commissions. The main thing to do is to buy into a wonderful business and just sit there with it. That's what I've adopted into my strategies. I try to find the best companies, do the homework up front, buy it, and sit in it. Those that are trading, they try to look at this like a job. At a job, the more action you take, generally things do get a little bit better. But in investing, it's the opposite. The more you touch it, the worse your returns generally are. So you find the good companies, you buy them when they're cheap, and then you just hold on. Gold is climbing the wall of worry towards the resistance of 2360 area. This is highly dependent, if we break this, on interest rates. Keep that in mind. Watch interest rates and watch gold and watch them move inversely. Translation, oil is trading as if the markets were tight, but they're not. The idea of a tightening market remains very much the remit of futures at present. Another thing that the market may be doing is they might price oil higher, not off of the demand and supply, but rather off the value of the dollar. That is what I wanted to talk about here. It's the value of the dollar that could push oil higher, not necessarily the demand and supply dynamics. Lower yields, XHB. So we had lower yields in the morning. This was up, and then yields reversed, and this actually ended right on support. I obviously have a stick save going on here. To achieve superior investment results, your insights into value have to be superior. Thus, you must learn things others don't, see things differently, or do a better job of analyzing them. Ideally, you can do all three of these better than other people, according to Howard Marks. The latest pickup in RRP starting to feed into higher liquidity stress. Time for more Fed. Daily index jumpy, but trend plainly rising. That is true. And here's another thing. Go look at the M2 money supply. It's increasing rapidly. I think they're in there doing something with this liquidity stress index, and I think they're in there trying to do some solving of problems, whatever those problems are. Liquidity is the problem, probably. Now here's silver versus the consumer price index. One is long-term, one is short-term time frame. We can see a breakout here where silver's outperforming the U.S. consumer price index. Is this a change? You know, we saw that breakout in 2003 here. Are we similar? We could be. We could be in a very similar situation as 0203. And this is zoomed in and how we could potentially break this flag pattern. For silver outperforming the consumer price index. This is gold to the consumer price index on different time frames. We're right at resistance. Potential big breakout. Potential big breakout here, guys. If you zoom in, we've got a cup and handle. Cup handle that's broken to the upside. That looks really good. Projected move way up above the larger breakout pattern. So we would break out of the bigger pattern here to the upside with a projected move on the medium term. And then on the short term, we've got another flag pattern that's flagging out for gold against the U.S. consumer price index. On every time frame, gold is bullish. Long term, medium term, short term. That speaks volumes, guys, because whenever you get this alignment, that is when you go big, in my opinion. It says, we're going ballistic, Mav. I like the quote here, guys. This is natural gas power burn. Look at where we continue to go up. We continue to use more natural gas for electricity generation. And this is 2024 versus 2023. And some of the weather does have an impact on this, but we are burning more natural gas for electricity generation in 2024 versus 2023. And these are the weeks to show that difference. We're in a commodity cycle lows, in his opinion. Precious metals will 4x below cycle highs. Energy is about 3.5 times below cycle highs. And base metals are about 4x below cycle highs. It says the next decade will be tremendous for commodities, base metals, and precious metals, and I can't agree more with him. There's the double bottoms. We have a bottom in 2000 to move up, and then we've got another bottom that we are at right now for a lot of these different materials. That is the Goldman Sachs commodity subindex for precious metals, base metals, and energy versus the S&P 500. It's a ratio chart that we're looking at here. So all the money's piled over in financials. This is all going to rotate into commodities with time. Charlie Munger says, being prepared on, I already talked about that one last time. So we're going to end it there, guys. That's what we've got for today. Thumb up for the content, guys. And that's all I've got for today. So we've got a Sunday question and answer session coming up at 5 p.m. Mountain Time. If you guys have questions, you're part of the community, hit me up there. You can send me questions beforehand, and I can write them down, record them, and then do those in the beginning of the question and answer session if you've got any other questions and can't make that Q&A session. All right, guys, that's all I've got. We'll catch you next time. This is Finding Value.